Today, we're going to look at the forecast of where rates are going, as well as the housing market outlook. Stick with us till the end. We're going to look at consumer sentiment. We're going to talk about Australia's household debt at record levels and how international arrivals might impact the rental market. Let's dive in, starting off from the top and having a look at where things are at. So we know the ANZ has recently updated their forecast and pretty much said that they think rates are going to be higher than where they initially anticipated earlier last year. So let's have a look at this and see what's going on. We've seen that with the ANZ's recent forecasts being updated, this is actually reverberating through the rest of the economists, bankers, and even the finance and property industry this week. The Reserve Bank has actually publicly stated that the official cash rate is still probably well below where it needs to be. Now, I guess that's a little bit leaving the door half ajar there. We know the Reserve Bank has been really criticized for their views on rates whilst we were in the pandemic, saying nothing was going to change until 2024. And now we see the Reserve Bank being a little bit more vague, being a little bit more coy about the way they word things and saying that they see rates going up, but really not giving us much indication. It's a good thing that we've got the Reserve Bank giving us a bit of an understanding. So despite the Reserve Bank of Australia's view that Australian households are well placed to manage further rate hikes, it'd be without ramifications because the ANZ's revised their forecast and they're actually saying that they see that the cash rate will increase to 3% by Christmas. So they're saying they're predicting another 4 massive rate hikes over the next 4 months, which will take our official cash rate to 3%. Currently, we're sitting at 1.35%. So that's nearly a 2% increase to come, or a 1.5% to go. So we might actually see a 0.5% increase this Tuesday in August, another 0.5% come September, maybe even a 0.5% October, and then potentially 0.25% come November. Could be more. I mean, it'll be interesting to see how this plays out. Now, on Tuesday, the ANZ revised their predicting, saying that there's strong momentum in the labour market and clear upside risks to inflation, which is going to force the Reserve Bank to move to more of a restrictive setting by late 2022. So the ANZ's come out with that, which has actually been reverberated throughout the market with a lot of the other lenders. We saw Westpac coming out as well and pretty much agreeing with what they've said there. Now, what we're actually going to see is with this bad news, I guess the trajectory for housing values is that we're going to find things will continue to potentially go downwards. We saw this when the first rate hike happened in May. The downwards trend in house value growth steepened. And with that decline, we've actually started to see areas like Sydney and Melbourne have an accelerated decline. And we've seen that all over the news. I mean, it's been really publicized all over, but we're actually interestingly starting to see places like Brisbane, where previously they enjoyed a long run of growth. They're actually starting to see a little bit of decline with these rate rises. Now, Sydney's housing values are down 4.4%. And if we look at Melbourne, they're down also 2.6% since obviously the first rate hike started happening in May. The growth in the housing market is broadly slowing down across the country. So we're seeing this across most regions and cities. And if we have a look here at some of the data that's coming through, we can see CoreLogic's daily home value index give us an idea on the daily change of where things are going. So we can certainly see the rate of change for Sydney and Melbourne is quite negative. Of the 5 now capital cities, we're seeing Brisbane starting to slow down a little with a little bit of negative growth there. Perth as well, interesting, starting to come off the boil. Adelaide had a fair bit of momentum. If we look at the year-on-year change, we can see Brisbane and Adelaide there with the two major growths, the lion's share of the growth across this country, and starting to slow down. And it makes sense with all these rate rises and what's going on. Now, with the mapping data that we've recently seen, we ran through this the other day, CoreLogic showed 3,085 households and analyzed both the housing and unit markets. And when they looked at the numbers, they saw that 41.9% of homes analyzed in that data set were in a decline of value compared to where they previously were. Now, having a look at that report here, we can get a good idea on the median value change. Looking at Sydney, we can see a large, pretty much most of Sydney now is recording negative growth. Now, to put that into a bit of context and why this is important to know, and to give us a bit of a different perspective, at the height of the property downturn, so that was in 2017 to 2019, almost 81% of houses and units recorded a decline in value. So currently we're at 41%. At the height of the downturn, we saw it 81% back in 2017 to 2019, recording negative growth. In the early phase of COVID-19, the housing market went through a broad-based but a short-lived decline. That's where we saw 67% of the market declining from its previous peaks. Now, this gives us a bit of perspective as to where we are at the moment, currently at 41.9%, where things could potentially get to. Now, households are at record levels of debt, and most of the debt for households is actually tied up with assets, mainly homes. Now, what that means is we are highly sensitive to these interest rate changes. So increased costs on interest rates mean that there's going to be increased costs across the board. So what this actually puts households in is an extremely tough position, because as prices for mortgages increase, discretionary spend stops, and we're actually seeing non-discretionary costs such as food and fuel increasing. So there's a double whammy effect happening here, and it's clearly going to have an impact on household balance sheets and make it a real challenge for mortgage holders, even those renting, because rents are going up as well. Now, looking at some numbers here that we talked about, I mean, one of the things the Reserve Bank looks at is the unemployment rate. We can see that's at an all-time low at 3.5% based on the June quarter. Unemployment being exceptionally low means that the labor conditions and the labor market conditions remain tight. There isn't a great deal of concern for households that they'll fall behind on their debt repayment schedule. However, there is households that will be pulling back on other areas of expenditure. And what we know is when that happens, that has a flow-on effect, because someone's spending is another person's income, which, continues to become a self-fulfilling feedback loop where there's less spending, less money to go round and round and round, and things start to really go back down. The Reserve Bank also estimates that their mortgage holders have about 21 months worth of mortgage repayments as a buffer, and that should hopefully cushion some of the distress in the mortgage sector. I would love to see how the Reserve Bank got to that figure there, because I have a feeling that there are a number of households that are struggling at the moment, and the Reserve Bank estimating that variable home loan borrowers have 21 months of repayment cushion. We'd love to see that. Leave a comment below. I mean, let us know if you've got a mortgage. Do you have a cushion? Do you have a bit of a buffer there to protect you in these times? Or do you think the Reserve Bank's maybe just giving us numbers to give us peace of mind like they did previously, where they said rates weren't going to change until 2024? Now, when we look at consumer sentiment, that is starting to trend down. Westpac had some information there around the consumer sentiment. So as we can see here, sentiment's fallen 3% to 83.8%. Looking at the graph on the right, we can see that we're starting to get to pandemic sort of levels of consumer sentiment. It definitely has reduced, and we're seeing that confidence is now down 19.7% since December last year, which I guess has been falling every month since 2022. Both the level and pace of the deterioration is comparable to major previous shocks. So when we look at the COVID pandemic. Now, as rate fears intensify, 73% of those polled post RBA are expecting that there's potentially another 1% of rate rises to come. So, I mean, that falls in line with a lot of the information we're being told with the Reserve Bank and the expectations, like we talked about earlier with the ANZ. And we are starting to see house prices expectations cooling rather rapidly, led by New South Wales and Victoria. Now, this survey looks at 1,200 respondents over a 4-day period, and that's where they get an understanding of consumer sentiment. Now, when we look at last month's levels, we're roughly around where we were when the COVID pandemic happened, the global financial crisis happened, the recession in the 90s, and the slowdown in the mid-80s, as well as the recession in the early 80s. So consumer sentiment is starting to get to a point where we are getting to recessionary levels or pandemic levels like we've previously seen in the past. And the index has fallen, as we talked about now, 19.7% since December. So it has consistently really fallen since the start of the year. And the drivers are really, main one being when they survey the consumers out there, inflation. Around 60% of respondents are worried about inflation. That's compared to a long-running average of 12%. So that's quite elevated. Another worry for consumers out there is the domestic economy. 43% of respondents were worried about that. Interest rates, I'm surprised that's lower. That's only 24%. I would have thought that might be something that's weighing heavier on consumers' minds. And then international consumers, international conditions weighing up 23%. So definitely interesting data there. Now, those renting at the moment or looking for investment properties, overseas arrivals and departures are actually starting to show ongoing and more moving to a normalization level that we saw pre-COVID. So the return of migration back to Australia is a flow on into additional pressures into the rental demand. We're going to see that come full force. We're already seeing an issue and a bit of a pressure on the rental market. And this boost in demand is already elevated, as we talked about there. So the arrival and migration of more international workers is really going to highlight and put pressure on the rental market. And we're actually starting to see the gradual boost of tourism sector, both internally in Australia. So if we look at international arrivals month by month, we can see a massive uplift, definitely consistently over the last 12 months, really from the low when international arrivals were stopped over September, October last year, and gradually picking up, which is a large increase. And then even when we look at net migration, quite reduced at the end of 2021. However, we are starting to see that increase. We'll get some data for 2022 at the end of the year, but we would expect that to increase. So definitely really interesting. In terms of where the market's going at the moment, it is clearly evident that rates are increasing. They're set to potentially get up to 3% by the end of the year, as the ANZ has said. I mean, we've talked about fixed and variable rates. There's a bunch of things you can do if you have a mortgage. So if you are worried and you want to have a chat, give us a call on 1300 088 065. We're mortgage brokers. We're based in Brisbane. We deal with people Australia-wide. So if you're in Sydney, you're in Melbourne, you're anywhere else, we certainly can help. We can review your situation, see what you can do. If you're thinking of getting a rental property or buy your first home, something we can help with as well. Visit us at huntergalloway.com.au, guys. Please leave a comment below. Also, let us know what you think. If you want us to cover anything in specifically, leave a comment below. We're always happy to have a look and see what we can do for you guys. So thanks so much for watching. We'll see you again soon. And until then, we'll catch you next time.